Hi class, today I am going to go over some practice journal entries. So the ones I'm going to focus on for this video are found in the Chapter 2 folder under coursework on our course Blackboard site. And the file you'll be looking at is Chapter 2 Extra Comprehensive Problems for Practice. Okay, now that you have that file open, we're going to step through a few transactions to practice some journal entries. I'm going to use the transaction analysis template, which again you can find back on the course Blackboard site, right in the Chapter 2 folder. You don't have to use this, but a lot of students find it helpful, especially when they're first getting started. So if we look at the first transaction here, it says January 2nd, Lou Dobbs invested an additional $45,000 in Captain Lou's Landscaping by depositing $45,000 in a checking account in the name of Captain Lou's Landscaping, Inc. Capital stock is issued. So Lou Dobbs is getting his business started here. He's investing $45,000. One thing we want to keep in mind is that we're looking at this transaction from the point of view of the business, not the individual owner or investor. So for this first transaction, we're going to date it January 2nd. One thing you may find helpful as you get started with practicing journal entries is to try to break the transaction up into pieces. So this first one, for example, as we read it, Lou Dobbs invested an additional $45,000 in Captain Lou's Landscaping by depositing $45,000 in a checking account in the name of the business. So right off the bat, we know from the point of view of the business just received $45,000 in cash that did not have previously. Okay, what kind of account is cash? Well, it's an asset. It's something that the business owns. It's going to provide future benefit to the business. So to increase an asset account, we're going to debit that account for $45,000. Okay. That's part one. Now we know every journal entry we book has to have at least two accounts because of our double entry accounting system that you read about in your textbook. So the second part of this transaction on January 2nd said capital stock is issued. So we know we need to credit capital stock. You might call that contributed capital. That's the phrase the book uses more often. Either one is fine. Well, what kind of account is capital stock? Okay, it's not something that the business owns, right? It's equity in the business. So that's stockholders' equity. It has also been increased in this case because we've issued additional stock. And to increase a stockholders' equity account, we need to credit that account. Same $45,000. On the right-hand side of this transaction analysis template, again, if you choose to use it, you want to go ahead and mark the effect that transaction had on the financial statements in general. So this first transaction, did it have any effect on the income statement? Either my revenues, expenses, or net income? No. So we'll just leave that all blank. We did increase our assets by $45,000. And we also increased our stockholders' equity by $45,000. Cash was involved, so this activity would appear on the statement of cash flows. This activity, the issuance of stock, is always a financing activity, and we've increased cash, so it's a cash inflow. So we'll denote that F+ for financing inflow. And that's it for the first transaction. Whenever you finish a transaction, you book a journal entry, make sure that your debits equal your credits. Also make sure that your balance sheet would still be in balance. So that is, you've increased or decreased this side of the equation, the asset side. You need to have done the same thing to this side, liabilities plus stockholders' equity. Taking a look at the next transaction, we see that also on January 2nd, the business borrowed $4,000 from Citibank for 5 years, signed a promissory note with an annual interest rate of 9%. Again, break that up as you go. So January 2nd, first two words, borrowed $4,000. Well, we know we've once again increased our cash by $4,000. So we're going to increase the cash account, $4,000. Well, where did we get that $4,000 from? We borrowed it from Citibank. We have to pay them back, right? We owe them $4,000, and we signed a note to that effect. So we're going to call that notes payable. Notes payable is a liability account, right? We owe them $4,000. We've increased our liability, so we need to credit the notes payable account for the same $4,000. Once again, this transaction had no effect on our income statement accounts. There was no revenue involved, no expense involved. We did increase our assets by $4,000. We also increased our liabilities by the same. So our balance sheet would still be in balance. Once again, cash was involved, so this would appear on the statement of cash flows. And once again, this is a financing activity, and we've received cash, so it's a financing inflow. All right, let's step through a couple more here. So next up, we have the transaction again on January the 2nd. It says purchased equipment from John Deere, $16,200, paying $9,000 cash, and signing a 3-year note for the remaining balance. So once again, January 2nd. If we break this one up, purchased equipment from John Deere, $16,200. Stop right there for a second. Purchased equipment. What kind of account is equipment? Well, it's something the business owns. It provides us future benefit, so it's an asset. We've increased that, so we're going to debit the equipment account for $16,200. Okay, we know we need at least one more account, so let's continue reading. Paying $9,000 cash. Okay, well, we can stop right there for another second. We paid cash, again, cash being an asset, of $9,000. So we need to credit the cash account for $9,000 and signing a 3-year note for the remaining balance. So for the other $7,200, we're going to owe John Deere for the next 3 years. So we've increased our liabilities by signing another note payable, increase with a credit for the remaining balance of $7,200. Once again, this transaction in total had no effect on our income statement. What happened to our assets? Well, they increased by $16,200. They decreased by $9,000. So they had a net increase of $7,200. Our liabilities also had an increase of $7,200. Now, for our statement of cash flows, be a little bit careful here. We did pay cash to purchase this equipment. We still owe some money on it, but purchase of equipment is considered an investing activity. And we paid cash, so that's an outflow. So we'll signify that with a minus sign. You might want to note for situations like this how much was involved. If you're putting together your statement of cash flows and you're going back through looking at these transactions, you don't want to mistakenly indicate that's a $16,200 cash flow, because the cash portion was only $9,000. So that's why I denoted $9,000 right here. Moving on to the next transaction, one more time on January 2nd. Purchase supplies costing $2,000 from Southern Garden Supply by paying cash. If we choose to try to break this up a little bit, first part of this transaction reads, purchase supplies costing $2,000. What kind of account is supplies? Well, once again, it's something we own. It's going to provide us future benefit. So that is an asset. We've increased our supplies by $2,000. How did we pay for those supplies? We paid cash. So we need a credit to cash for the same $2,000. Once again, no effect on our income statement. No revenue or expense accounts were involved. Our assets increased by $2,000. They also decreased by the same $2,000. So you can either leave this blank. If you're doing this part, there was a net change of nothing. Or you can do one of these, plus and minus. As long as you keep in mind that in total, the balance sheet still balances. From a statement of cash flows perspective, usually we consider the purchase of supplies an operating activity, not investing. Investing we reserve for fixed assets like equipment, land. So supplies we consider an operating activity. And again, it's a cash outflow, so we'll denote that with operating outflow, O minus. We have one more transaction on January 2nd, and that is received $3,600 in cash for a 6-month lawn mowing contract for the city of Charlotte. First two words, received $3,600, next two, in cash. So what's happened to our cash account? That is increased by $3,600. Well, why did we receive $3,600? We were paid for a 6-month lawn mowing contract by the city of Charlotte, but they paid us in advance. So keeping in mind our revenue recognition principle, we only recognize revenue when it is earned. In this case, we've not earned any revenue because we haven't mowed any lawn. Okay? They've paid us in advance for service, so we in fact owe them 6 months worth of lawn mowing service. So we're going to call that account unearned revenue. Unearned revenue, since we owe them some service, is of course a liability. Okay? Again, owe being the key word. We owe them future service. We've increased that liability. So to increase a liability, we need to credit it. Same $3,600. Once again, no revenue or expense accounts were involved, so we have no effect to our income statement. Assets have increased. Liabilities have increased by the same amount, so our balance sheet is still in balance. And from a cash flow perspective, we are in the business of mowing lawns, providing landscaping services. So this is considering an operating activity, and it's an inflow. Okay, we received cash. Moving on to the next transaction. On January the 4th, we paid 1 month's rent for business space in Mallard Plaza, $750. Paid 1 month's rent for business space in Mallard Plaza, $750. We're going to call that simply rent expense. Okay, we recognize rent and any expense in the period in which that expense is incurred. Okay, so we used up 1 month's worth of rent. Rent expense is an expense account. We increased the expense account to recognize the expense. This is one thing where students tend to struggle a little bit in the early going. We're not decreasing the rent expense, right? We're increasing it because we're recognizing a new expense. That's $750. We paid that in cash, so we're going to credit cash for the same $750. Now we do have an effect on our income statement. Revenue hasn't changed, but we did increase our expense account. So if we increase expenses, by definition, we decrease net income. We've also decreased our assets. And because we've decreased our net income, we've also decreased our stockholders' equity in effect. Okay. Once again, the paying of normal expenses is considering an operating activity from a statement of cash flow perspective, and this is a cash outflow. Let's look at the next transaction on January the 12th. Services provided to new customers during the first half of January totaled $6,850. All of these services were paid for in cash. So we mowed a whole bunch of lawns, maybe we did some irrigation systems, whatever our landscaping duties entail. But we have received $6,850 in cash. Everyone paid us in cash. Wouldn't that be nice? So we have a debit to cash for $6,850. Now we've provided services in that same amount, and these are services we've already done. Okay, we've already mowed these lawns, we've already done the irrigation maintenance, whatever. So we have earned that revenue. So we're going to call this service revenue. That's a revenue account. We're increasing it because we've recognized new revenue. In order to increase a revenue account, we need to credit that account, $6,850. From an income statement standpoint, we've increased our revenue. Nothing has happened to expenses. So increase in revenue leads to an increase in net income. We've also increased our assets here by receiving cash. And because we've increased our revenue, we've increased our stockholders' equity as well, in effect. From a statement of cash flow standpoint, again, we're considering this an operating activity. In this case, it's an inflow. I hope this video has been useful. I will post others as needed, and if you have any questions, make sure you shoot me an email or otherwise check.